Have you ever stopped to ponder how the economy has evolved over the centuries and how it impacts your investments today? Let's take a moment to journey back in time, to the dawn of civilization. Picture a world where the barter system ruled, a time when goods were exchanged for goods. A cow could be swapped for a sack of grain, or a piece of pottery for a woven basket. This was the very first form of economy, simple and direct, but not without its limitations. As societies grew and diversified, so did their needs. This led to the birth of money, a universal medium of exchange. The advent of money propelled the economy forward, enabling trade on a larger scale. It was around this time that the concept of investment took root. People began to realize that they could use their money to make more money, and thus, the seeds of capitalism were sown. Fast forward to the age of agriculture, a significant era that transformed the economic landscape. The ability to cultivate crops and rear livestock provided a stable source of income and led to the development of settled communities. This, in turn, spurred on trade and investment in various sectors, from farming equipment to food storage facilities. Next came the wave of industrialization, a period marked by a shift from agrarian societies to an industry and manufacturing-based economy. The advent of machinery and factories brought about mass production, which led to a surge in economic growth and investment opportunities. In recent times, we've entered into the digital age, an era characterized by technological advancements and a shift towards a knowledge-based economy. Today we live in a world where information is a valuable commodity, and investments are often directed towards innovators and disruptors. From the barter system to today's digital economy, each economic evolution has presented a new set of investment opportunities and challenges. Understanding these shifts and their impacts not only gives us a clearer picture of our economic history, but also provides valuable insights into our current investment landscape. Understanding the past helps us make sense of the present and predict the future, especially when it comes to our investments. But how exactly does the economy influence our investments? Well, let's start with inflation. When the economy experiences inflation, the general level of prices in the economy increases. This can erode the purchasing power of money, meaning that the same amount of money buys less than it did before. For investors, this means that the real or inflation-adjusted return on investments may be lower than expected. Now, what about interest rates? These are set by a country's central bank and are a key tool for controlling inflation and managing the economy. When interest rates are high, borrowing costs increase, which can slow economic activity. However, for investors, high interest rates can be attractive as they offer higher returns on investments such as bonds and savings accounts. So how do market trends come into play? Well, market trends, whether bullish or bearish, can influence investor sentiment and behavior. For example, in a bullish market where prices are expected to rise, investors may be more willing to make risky investments in the hope of achieving higher returns. Conversely, in a bearish market where prices are expected to fall, investors may become more risk-averse and choose safer investments. But how can we predict these changes? This is where economic indicators come in. These are statistics that provide insights into the overall health of the economy. They include indicators like gross domestic product, unemployment rates, and consumer confidence indices. By keeping a close eye on these indicators, investors can make informed decisions about where and when to invest. For example, a strong GDP growth rate could indicate a healthy economy and potentially bullish market trends. On the other hand, high unemployment rates could signal a struggling economy and bearish market trends. Similarly, a high consumer confidence index could suggest that consumers are willing to spend, which could stimulate economic growth and potentially lead to bullish market trends. In conclusion, changes in the economy can significantly impact investment outcomes. From inflation and interest rates to market trends and economic indicators, understanding these aspects of the economy can help guide investment decisions. As we can see, the economy and investments are inextricably linked. So what happens to our investments when there are shifts in the economy? Let's dive into that. Imagine the economy as a vast ocean, and your investments are ships sailing on it. When the ocean is calm, your investments can smoothly sail, but when storms hit, your investments may be tossed around. These economic storms can come in many forms: recessions, booms, inflation, deflation, and so forth. So how do these economic shifts impact different types of investments? Let's start with stocks. In a booming economy, businesses tend to flourish. This growth can lead to increased profits, which can boost stock prices, and hence, stock investments generally perform well. However, during a recession, businesses may struggle. leading to falling profits and thereby declining stock prices. Now let's consider bonds. Bonds are generally considered less risky than stocks and can be a safe harbor during economic storms. In a recession, when stock prices are falling, investors may flock to the safety of bonds, pushing bond prices up. Conversely, during economic booms, investors might shift their money to stocks to take advantage of rising prices, which can lead to a drop in bond prices. And what about real estate? Well, real estate can also be affected by economic shifts. In a booming economy, rising incomes can lead to increased demand for property, pushing up prices. But in a recession, job losses and reduced incomes can lower demand for property, potentially leading to falling prices. So in essence, economic shifts can significantly influence your investment strategies. It's like adjusting the sails of your investment ships to navigate through the changing economic winds. To weather economic storms, investors may need to diversify their portfolios, balancing risk and reward across different types of investments. The key takeaway here is that economic shifts aren't necessarily bad for investments. They can provide opportunities for savvy investors to adjust their strategies and potentially find new avenues for growth. But remember, these shifts also come with increased risks. Investors must remain agile and adaptable to navigate the ever-changing economic landscape. What does the future hold for the economy and investment? As we move towards the future, there are several key trends that we can't ignore. One of the most significant shifts is the rise of cryptocurrencies. Cryptocurrencies, digital or virtual currencies that use cryptography for security, are becoming more mainstream. They're not just for tech-savvy investors anymore. Major corporations and even some governments are starting to accept them as a form of payment. This acceptance is driving up their value and creating new opportunities for investment. However, with greater opportunities come greater risks. Cryptocurrencies are notoriously volatile. Their value can skyrocket one day and plummet the next. So, while they offer the potential for high returns, they also carry the risk of significant losses. Another trend that is set to shape the future of the economy and investment is the impact of climate change. Climate change is not just an environmental issue, it's an economic one too. As our planet warms, industries such as agriculture, fishing, and tourism are being hit hard. On the other hand, sectors focused on renewable energy and sustainability are booming. Investors are starting to take note. They're shifting their focus towards companies that are not only profitable but also sustainable. This shift is giving rise to a new kind of investment strategy: impact investing. Impact investing seeks to generate both a financial return and a positive social or environmental impact. But what does all this mean for the future of investment? Well, it means that the investment landscape is changing. Traditional investment strategies may not cut it anymore. Investors will need to be more adaptable, more informed, and more forward-thinking than ever before. They'll need to consider not just the financial potential of their investments, but also their social and environmental impact. While the future of the economy and investment is uncertain, being informed and prepared can help us make the best investment decisions. In conclusion, the economy and investments are deeply intertwined. We've journeyed through the evolution of the economy, observed its profound impact on investments, and highlighted the vital importance of adaptability. As the economy ebbs and flows, our investment strategies must remain dynamic, adjusting to the shifts. The key to thriving in this ever-changing landscape is staying informed about the economic trends and being flexible enough to adapt your investment strategies accordingly. Stay informed, stay adaptable, and your investments will thank you.